Good morning. I asked Lance what size room I'd be speaking in today, and he said it would easily sleep about 500. Appreciate it, Lance. So I just came from the men's room, and there was a little sign above the hand dryer that said, "For a preview of Greg's talk, press button." Anyway. I got involved in money management about 25 years ago. My partner was John Murphy, used to be the technical analyst on CNBC. We started a money management company. Did pretty good. We used a trend following model that I'd created, and then a company named PMFM bought us, later became Stadion, and I've tried to retire a couple of times, but I'm fully retired from Stadium now. I'm the chairman of the board of trustees until the end of this year, and then I'm just a golfer. Let's see if I can figure this out. That's my bio. I'm going to leave it on there for about a second. It looks like someone that can't hold a job. One of the things that I learned when the portfolio management department got fully set up, I was in front of Merrill Lynch, UBS, Wells Fargo, Mutual of Omaha, Guardian, Lincoln, and I was in front of big-time advisors. And they'd all been trained in modern portfolio theory, and when I was in there trying to sell them on technical analysis and a tactical approach, they just didn't buy into it. And after a couple of years of what I considered fairly unsuccessful selling, because I really wasn't a salesman, I was a technical analyst, I realized that I could convince them on what was wrong with what they believed in. And I became very critical of modern portfolio theory, and I showed them many of the aspects of modern portfolio theory that were just hogwash. And it gained a lot of attention, and it turned my life around. So I'm going to show some of that today. I've got a book that's about 500 pages that I always tell people the disclaimer is don't drive a car or operate heavy machinery after you read any of it. So when we were young, our teachers and our parents taught us a lot of things, and we kind of accepted them as facts. One of them was George Washington cut down a cherry tree. The problem with that is it's not true. It's a story made up in the early 1800s by Parson Weems Locke. He was writing a biography on Washington, and he's trying to humanize him. But what a great story to tell your children. Here's the president of our country, the general of the Continental Army, the founding father, whose father found a cherry tree had been cut down, and he asked young George if he did it, and he said, "Father, I cannot tell a lie." What a great story. Like I said, it isn't true. They also said that Washington threw a silver dollar across the Potomac. Have you ever heard that? Well, there weren't any silver dollars back then. So I'm going to go through just a few of these. Dogs sweat through their tongues. Dogs don't sweat. Some believe bathwater runs out faster as it gets toward the end. That's an illusion. I was an aerospace engineer. That's an illusion because you don't see much fluid motion at the beginning, and then when it starts to swirl at the end, you see all that, and it's the appearance of running out faster, when in fact it isn't. Let me do one more here. Bathwater drains counterclockwise in the northern hemisphere. I tried to cover a whole bunch of different things, geography and science, trying to find things that you might have believed or still believe that just might not be true. The Coriolis effect, the rotation of the Earth, does cause weather systems, which are essentially frictionless, to rotate counterclockwise in the northern hemisphere. But in the southern hemisphere, they rotate clockwise. Bathwater is not a frictionless system. So bathwater just kind of depends on the drain and how the tub is shaped. It has nothing to do with Coriolis effect. So with that believable information, that leads me into the segue of what in the world of investing and finance have you accepted as a fact that just might not be so. It just might not be true. And so we're going to talk about some of that today. Buy and hold is the only way to be successful in the stock market. Dollar cost averaging is a good technique. Diversification will protect you from bear markets. Compounding is the eighth wonder of the world. I think Einstein is attributed with that comment. That's not the complete quote, but he left out an adjective. Positive compounding is the eighth wonder of the world. So you must remain invested or you'll miss the 10 best days of the year. I've got a chart to show you how ridiculous that is. Average returns are never better than compound returns. Probability and risk are the same thing. We'll talk about that. Equity allocation will protect you from bears. Oh, and I like this. Economists are good at predicting the market. If you watch the cartoon, I'm sorry, CNBC, you know that they're always parading economists across the screen, asking them what they think the market's going to do. And I think that's getting the cart and the horse reversed. The stock market is one of the 10 components of the index of leading indicators. So they're asking an economist what the stock market's going to do. The stock market is what's telling the economist what it's going to do. Chasing performance is a common technique. Boy, that is so true. Chasing performance is a sure way to be unsuccessful in the market. I don't think I have to comment on this. You just need to look at it real close. That slide was from my late friend Ian McAvity. I don't know if you knew Ian. He wrote a newsletter called Deliberations for about 45 years. And he died suddenly last year, but great guy. So now I can steal his slides. Okay, this is a little scary here. That equation, that's what modern finance wants you to think that they do when they're sending out research and all that. And we're going to come back to this toward the end of my presentation. When I first started, like I said, I was an engineer. I didn't major in finance or economics, so I'm self-educated. I've just read everything I could get my hands on. And I found out that modern finance started out with some basic assumptions like investors are rational. Think about that. Investors are rational. The markets are efficient. Now, I do think the markets have a certain efficiency to them, but not in any way you can measure or capitalize upon. And the other thing we're going to talk about is risk. They think that risk is measured by volatility, and the volatility they use is a statistical term called standard deviation. Well, I've got to tell you, as an engineer, that's all just nonsense. Every time you start to do a research project, you have to begin it with some assumptions. But as you get further into the research, you might have to go back and say, well, those assumptions were bad, let's change them. Modern finance is stuck with these assumptions now for 60, 70 years. Oh, I didn't mean that. So I think that risk is drawdown, loss of capital. This chart, that red line at the bottom, is the cumulative drawdown of the Dow Industrials. I think I have it back to about 1960. And you can see the four red lines. One's at minus 20%, one's at minus 35%, and the other's at minus 50%. And so when that line is all the way down, almost between the 35 and the 50, that was the bear market in 1973 and 74. There's one thing about drawdown that people forget about. It's not the magnitude of how far it goes down, it's how long did it stay or remain in a state of drawdown. And that's the problem. I'm not sure how I'm going to point to two slides, but you can see that in 1972 right there, it was 1983 before it got back up to where it had been. That's 11 years. 72 to 83. That's 11 years where if you were an index investor or a buy and hold investor, your money didn't grow. You eventually got back to where you were 11 years later. You just stalled on your retirement plan. Bear markets, they exist. They always will exist. We haven't had one in a while. We're going to have one. I have no idea when we will. But being a defensive money manager, I'm prepared for it when it happens. This shows you all of the bear markets in the Dow back to 1885. I wasn't around then, but you can see that the average drawdown was 41%. That's a big drawdown. That's the average. Now, if you eliminate 1929, it drops it down to 38%. Bear markets are going to happen. We're going to have another one. I really don't want to repeat myself, but I want to make sure you understand that there will be another one. You need to have a plan to avoid riding that bear market down, and I'm going to show you what can happen to your portfolio later. 41.79% decline requires a 72% gain to get back to even. That's called equivalent return. This is another example of drawdowns. I've got these charts in my book. Basically, there's the bear markets, less than 20%. That's the average duration. But then I did it for all other drawdowns. There's from 15 to 20%, 10 to 15, 5 to 10, and even 0 to 5%. Even the little daily volatility drawdowns, I did that to show you all of the drawdowns. And if you look at the percentage of time that the market stayed in a state of drawdown, in other words, it was lower than it had previously been at some point, 96% of the time. Most people are shocked at that. I was shocked at it, but I'm doing this on a daily basis. Modern finance likes to use monthly data. I've never understood why they want to eliminate 95% of the data, but monthly data would show that at about 80% of the time. Let me say that again. The market is only making a new high 4% of the time. The rest of the time, it's correcting or doing something else. This is a chart of the Dow again. This is the annual returns in a histogram. You can see 10%. These are the gains over here. The losses are red. And you can see that if I were selling you an index fund or a buy and hold strategy, I could say, look, the market's up 2/3 of the time. There's a lot more green ones than there are red ones. And I'd be correct, wouldn't I? But those are just statistics, aren't they? So let's play a game. I promise you it's a fair game. It's $10 to play. You can play as many times as you want. If you win this game, you're going to get $1 million. And the honest mathematical probability of winning is 1 time out of 6, and there's no tricks. How many want to play? It's Russian roulette. How many want to play now? What happened? I changed your focus from those goofy statistics to the risk of playing the game, and you no longer want to play now. You should always focus on the risk of whatever you do when it comes to the stock market. If you ignore the risk, you're going to pay the price. So these are the equivalent returns. This is just a chart. You can find this online anywhere. Most people don't have any idea what it is, but if you have a 50% decline, it's going to take a 100% return to get back to even. Getting even is not a strategy. It's a hope. What you want to do, you want to avoid having the big losses so you don't have to have these big returns to get back even. But you look down here, about 70%. What is that? 70% takes a 233% gain to get back to even. Most people have never had a 233% gain in their life. Oh, here's the chart on the 10, Wall Street likes to say, you got to stay invested or you'll miss the 10 best days. Well, that's hypothetical. You can't not miss them if you stay invested. So I turned it around and says, well, what if you miss the 10 worst days? Well, the red line is the 10 best days, and it is bad, but what if you miss the 10 worst days? Fantastic returns. And then there's the buy and hold and missing all the 10 best and the 10 worst. So Wall Street likes to play these games with you to try to keep you invested. There's the days since 1926. I mean, the numbers are astronomical. Diversification, it's a free lunch. Absolutely, you should always be diversified, but you need to make sure you understand what diversification is. It's not owning a bunch of stocks. It's owning stocks or ETFs or whatever that are in different asset classes and or different sectors. That's diversification. And it will help you. But here's a chart of a very diversified group of mutual funds. What is that, from 2000 to 2006? And people say, well, where's the first bear market from 2000 to 2002? That bear market started in 1998. Only the large cap growth stocks continued up for 2 years before the rest of the market finally corrected. So I say diversification works until it doesn't. This is the 2007 to 2009 bear market. Everything went down. That was a bond fund up there, but everything was correlated. A bear market has a tendency to drive all correlations to one. One means they are correlated. Compounding is the eighth wonder of the world. We talked about that earlier. You can see that investment option A has some nice returns there over a 3-year period, 10, 6, and 8%, averaged 8%, compounded returns 8%. Let's take investment option B. Wow, 36% the first year. You think, that's got to be a better one. 8% the next year, that's fine. But then they lost 20% in the third year. And look what the results are. 5.4%. Significantly less return because of one bad year. Compounding, positive compounding, is the eighth wonder of the world. So what's wrong with modern portfolio theory? I mentioned these earlier. The markets are efficient. Investors are rational. I mean, seriously, investors are rational. It's almost comical. Returns are random. There are trends in the market. I will say that there are price trends. Return trends could be closer to random than price trends, but technical analysts deal with price, not returns. Returns are normally distributed. That means they adhere to Gaussian statistics, which we'll talk a little bit about. I'll try to shoot some holes in that. For you, Gaussian bell curve statistics, that's what's used by Wall Street. Do you know why? It's because it's easy statistics. The Paretian distributions that deal with the fat tails, they won't touch it because they can't sell it, because they can't explain it, first of all. So they stick with Gaussian statistics. Those are the same statistics you use when you're, say, I want to know what the height distribution is of all men in the United States. That they're going to fall within a certain range, and they're going to fall under what's called a normal distribution. Volatility is risk. That's nonsense. 60-40, you see that a lot. That's Wall Street trying to make you think they've come up with this grand plan. I'm going to poke some holes in that a little bit. Comparing forward guesses on PE with trailing. I don't look at PEs, to be honest with you, but if I did, I'd look at real numbers, which are the trailing earnings reports, not the guesses about the future. So what modern portfolio forgot or ignored? People trade totally differently. They use different time horizons. They have different views of risk. There's investors, there's day traders, there's medium-term traders. They all have a different view on where a stock's price is going to be. Capital asset pricing model assumes investors agree on everything, correlations, returns of all assets, et cetera. It's just not true. So this is a Gaussian bell curve in standard deviation. You've seen this in high school statistics, I guess. What I did is I took the returns on a daily basis of the Dow back to 1885, and there's the Gaussian, the gray bell curve, if you will. The dark numbers are the actual daily returns for 35,000 days. And you can see they have a lot of tails out here. There's 1987 right out there. 1987. So the probabilities of an event happening. Sigma is the statistical word for standard deviation. So if you have a sigma of 3, that means that 98.4% of the data is contained in that 3 sigma area, and the rest are outliers. the probability of that event occurring is about once a year. You get down to 1987, when we had a 22 sigma day in the market, a day that statistically should have never happened. You're down here talking about once every 9.51 times 10 to the 103rd. Now, I don't know if you have math or you remember that, but that is a number beyond human capacity to even grasp. You can't even come close to understanding what that means. But I'm going to try to show you. So 22 sigma, the speed of light is fast. 186,000 miles a second. So the speed of light in an hour is 670,000 miles an hour, and you expand that on down. I'm just trying to get some giant number using the term we've heard of. And you can see that the speed of light in a year is whole bunch of numbers per year, or in scientific notation, 5.8 times 10 to the 12th. October 19th, 1987 was a 22 sigma event, and that's about a speed of light in 10 to the 12th on that last slide would have been about a 5 sigma event. You see the difference? It's astronomically different. The reason being, Gaussian statistics shouldn't be used to measure the market. That's the point I'm trying to make. So I did another test, academic sigma I call it. You've got a look forward area. You determine the daily return in the sigma. And then what I wanted to do is measure it on I just did it for 5 years. I did it for a bunch of different years in the book, but in this example, you do it for 5 years to determine how many days in 5 years of data, of daily data, did a return fall outside of a 3 sigma band. Does that make sense? How many days? And then I go look forward and measure it, and I actually find out how many days it was in the new data. And this is a chart going back. This is a moving 5-year look back, 5-year look forward. And you can see this example right here that from 1992 to 2002, that's the 10-year period, there were 49 days where the sigma was above 3 sigma and 69 days when it was below 3 sigma. That is 118 times when it exceeded a 3 sigma band. Gaussian statistics says it should have only happened 1.7 times. We'll call it 2. Do you see the problem? So when Wall Street is talking statistics with you about the market, they're blowing smoke in your face. The statistics are totally inappropriate. So risk and uncertainty is volatility risk. Here we go again. In the sterile laboratory of modern finance, risk is defined as volatility as measured by standard deviation. Rarely do the markets yield a normal. So if an investor opens his brokerage statement in, say, late January, and he looks at the data and it says his loss for the year was 35%, but his standard deviation was 0.65. Do you think that investor knows what risk is now? Is he going to say, oh, that was 0.65, 35% loss? He knows what risk is. Modern finance doesn't. They'll focus on that standard deviation. Risk and uncertainty are not the same thing. Risk is a mathematical determined quantity. It can be measured. Uncertainty cannot be measured. When I was in college, or maybe high school, I don't remember, I talk about this jar. We called it an urn back then. I mean, an urn, wasn't that back 2,000 years? Anyway, we called it an urn. So you have an urn with 5 red balls in it and 5 blue balls, and you're blindfolded. What's the probability of pulling out a red ball? Well, you've got 10 balls in there. Half of them are red. 5 divided by 10 is 0.5, so it's a 50% probability. That's a risk. That is mathematical. Uncertainty. What if I said, here's an urn, and it's got a bunch of red balls and a bunch of blue balls in it. Can you tell me what the odds are of pulling out a red ball? You can't. There's no mathematical way to do that. It's impossible. That's uncertainty. Guess what else is uncertain? The stock market. There is no one, now I'm expressing opinion here after 45 years of doing this, there is no one who knows what the market's going to do on Monday, next week, next month, next year, or any time in the future. But there's a lot of people that play a lot of games making guesses at it. I would love to see on the cartoon, CNBC, where if you're on there making a prediction and you're wrong 3 times, your career's over. You got to go do something else. It'll never happen, but I'd love to see that. I did a lot of aviation where your first mistake might be your last. So risk is not volatility, it's drawdown, it's loss of capital. Now, I will say this in fairness, volatility, even standard deviation volatility, is a fairly decent proxy for risk in a short-term basis. It's kind of all you have. But much longer term, the drawdown is a much better. Volatility does not contribute to risk, but it also contributes to market gains. You got to remember, the volatility is not always a negative event. You can have positive volatility that causes the market to go up. So the heart of modern portfolio theory is you've got capital asset pricing model, modern portfolio theory, efficient market hypothesis, random walk, option pricing theory. Risk is at the basis of every one of those theories. Modern portfolio risk, it's the concept behind it all, but what kind of risk is it they're talking about? There's another type of risk called systematic or market risk. What modern portfolio theory talks about is diversifiable risk or non-systematic risk. Does that make sense? But bear markets and drawdowns are from market risk and systematic risk, and guess what deals with that? Technical analysis deals with that. And it's a much larger piece of the risk pie. So the ivory tower of modern finance deals with this little chunk of risk. Technical analysis deals with all the rest of it, or a tactical approach. Here's a chart I used a lot of times. This is the last bear market we had from October 9th of 2007 up till I think February of 2013. 5.5 year period. The blue line is a buy and hold line. I'm pointing at this thing, sorry. The blue line is a buy and hold line. In other words, it took 5.5 years. You went down 52%. The market came back, and now you're back even 5.5 years later. What if you were withdrawing? What if you were retired? And let's take someone who was minimally capitalized for retirement. In other words, all the math was there. He said he had enough money to retire, but he didn't have a lot of extra money, but he's in a buy and hold situation or an index owner, and he rides this market down. He's pulling money out to live on. He has no other income, so he's pulling out 6% a year out of the account, and we calculate inflation. Inflation's going to eat at it. This number seems a little high, but over time it's probably closer to average. His account is that red line. In other words, he's going to go down with the market, and then he's toast. He's not going to go anywhere. The market, his account's going to dawdle sideways because he's pulling money out now, and inflation's still having its effect. He's not getting the growth needed that would take him back to even like it was. Very scary. I spent a lot of time on the stage in front of people 55, 60, and older, and this chart gets their attention every time. Don't ride a bear market down. It's devastating. You've all heard the terms alpha and beta that they use in modern finance. Like I said, the engineering here kind of gets me going on this. So I took a couple of examples to show people what alpha and beta is. Basically, you take a scatter chart. This is called a Cartesian coordinate system for the engineers here. But you have an x-axis and a y-axis, and you plot the return of a mutual fund relative to a benchmark, say the S&P 500. And so you plot all those dots on there of the returns of the two, and then you do what's called a least squares curve fit. Well, it's a straight line that represents that data. It's a linear analysis for scattered data. It's a very poor way of doing it, if you ask me. And then they take that line and they say, well, the slope of it is beta, 2.25 in this case, and alpha is where it crosses the y-intercept, minus 0.6 here. And that's where alpha and beta come from when you see all this stuff. And I'm going to show you why I think it's bogus. So I took a ABC equity, generated a scatter chart on it, and I did the formula y equals mx plus c. So that's the slope, and 0.05, that's where it crossed the y-axis. And then r squared is called the coefficient of determination. This again, you're getting into academics. Correlation is r. If you square it, it's correlation squared. Why would you give it another name? I don't know, but they did, mainly to fool you, coefficient of determination. And it shows you how one is dependent upon the other. It's kind of an interesting tool to use, but I'd much rather just use correlation. So here's the coefficient of determination there, 0.796, same here. And then I take another equity. I back up. I have to leave myself notes every once in a while. I think they square it because they're afraid of negative numbers. So here's another equity, but notice how this chart, the returns relative to the benchmark are scattered all over. And I had to manipulate this data in Excel for a long time to get what I wanted to show you here. But I managed to get the data placed on the chart so that the equation down here, y equals mx plus b, the beta and alpha are identical to that previous chart. But look at the correlation of the squared, much, much smaller because the data is very scattered on the chart. Here's both of them together. Same line representing both of them. Same alpha, the same beta, but one's very correlated and one isn't. In Morningstar, I shouldn't have said Morningstar, that company that ranks mutual funds with stars, they don't tell you if it's correlated or not, but they'll tell you what the alpha and beta is. If you're reading alpha and beta without seeing if it's correlated or not, you're wasting your time. If it's correlated, then alpha and beta have validity. If it's not correlated, ignore it. But they don't tell you that. Do you think I've become a curmudgeon after 45 years? 60-40. You see that all the time. The problem is it's a 50 years of data that they use. And the latest one I saw was from 1960 to 2010. And so I took each decade and I said, let's do an efficient frontier on each decade of them. And it's all over the place, isn't it? Look at those up there. Those bonds, what is the blue there? The bonds are, well, I guess I can look at the 90s. The 80s and 90s are those top two. Did you really want to be 40% in bonds when we had this huge bear market? And then these down here, the bottom. Did you really want to be 60% in stocks then? So when you're using a 60-year average to sell something, that's one thing, but it doesn't work for an individual because you don't have that long to invest. I got to talk about this. Lance, I guess you're going to tell me about the time. I don't. 10? Okay. Discounted cash flow model. My gosh, what a complex thing this is. There's 6 major components. I'm not even going to read them to you. There's just a lot of them. And I tell people, I say, any one of those components that the guess of what they are is wrong, the whole model blows up. And all 6 components are just kind of educated guesses. And like I said, just one of them can be off and the whole model blows. I tell people it's kind of like the Hubble telescope. You move it a fraction of an inch, all of a sudden you're looking at a different galaxy. 85-year returns. You see this in Morning, that company that rates funds by stars, and Ibbotson and all that. And it shows you that long-term returns are 10%, large cap returns are 10% on annualized, and the small caps are 12%, and it's true. It was. What's wrong with that? Do you have 85 years to invest in? Not even close. Most people, you're probably in your 40s. I mean, when you have kids and you're materialistic, buying new cars that you don't need, and mortgages, colleges for kids, most people, and I'm generalizing, most people are not really socking it away till they're in their 40s for retirement. So you've got 20 or 25 years to put it away. And I can show you in that 85-year period where there were 25-year periods, you didn't come close to those returns. So here's a 10-year total returns with those numbers kind of used. In the middle one, that's 8 to 12% returns, and greater than 12 on the right and less than 8% on the left. And remember those two numbers, the large cap and the small cap, the 8 and 10%, they fell right on this middle chart. They were only averaged 22% of the time. Modern finance misuses the word average more than anybody I've ever seen. It's kind of like the 6-foot-tall Texan who drowned while wading across a stream that averaged only 3 feet deep. Guess where I went to school? Forecasting, I'm going to have to skip this to get into the next part, but there's Bill Sheridan wrote a book called The Fortune Sellers. I'd recommend you read it. He says that there's just nobody that's a good, consistent forecaster. You've got your one-shot wonders, and like I said, on the cartoon, CNBC, they're parading forecasters across there all day long. And I think people want to hear forecasts because they don't have the confidence to do it themselves, and that's really a sad state. Personally, I'd say you need to turn all that off, do your own thing, come up with a trend-following system, and just adhere to it, and you'll be so much better off. But it took me 40-some years before I could do that. I've got master's degrees in what not to do. Kenneth Arrow's story, I think Kenneth Arrow's still alive. He was an economist. He's probably in his 90s today, but during World War II, he was put in the weather department. They didn't call it meteorology back then. And he was tasked with providing monthly weather forecasts for all the various theaters around the world. And after 2 years, he goes to his commander and he says, I'd like to get transferred out of here because these forecasts are no good. They're no better than a coin toss. And the commander says, well, we know that, but we need them for planning purposes. True story. So investors do like predictions. It's called, there's a confidence bias, they call it. Investors like to hear people that they trust make predictions, and especially if the predictions fall in line with they kind of think, then it kind of gives them supporting evidence. It has nothing to do with whether you're going to make money or not. I want to scroll right through this because I told Lance I always have more slides than I need because I can stop at any time. Sell in May and go away is a classic example. You see that all the time. My question is well, there's 21 days of trading in May and there's 6.5 hours of trading each day, when exactly do you sell in May? And same thing when you buy in November. When exactly you do that? And so let's say you've gone back 130 years of data and you found out that the exact best time on average to sell in May and the exact best time to buy in November. Okay, right down to the minute of the day. These are actually the best numbers. And let's say it works 75% of the time. Wow, that's a pretty good confidence level. And let's say you decide to do that next year. Now this is a strategy. It takes an entire year to evolve. And the first 2 or 3 years or 3 or 4 years, it didn't work. How long are you going to stick with it? People forget that some of that data had to contribute to the 25% of the time that didn't work. You're always focused on the 75%. You need to focus on the 25% because that's what you're going to have to live with. This is almost it. Analog charts. I see this is a technical analysis thing that just drives me nuts. People will take data from a different time frame and overlay it with the current time frame and say, look, the market's about ready to crash. Or they'll use the price of butter in Mumbai and overlay it with the S&P and say, it's about ready to crash because butter just went down in Mumbai. Correlation is a mathematical property. It is not a visual property. So here's a little test. Are those correlated? Closer to 1, closer to 0, closer to minus. 1 is correlated. They sure look it, don't they? But you know I'm here to trick you. That correlation is, they're perfectly inversely correlated. Now, I had to do a little trick to do this, so bear with me. There's daily data in there, those squiggles, and when I calculated this in Excel, I made sure they worked exactly opposite of each other. So the little daily correlations are opposing, they're inversely correlated, but when you look at the big picture of the big lines, they look very correlated. So the next test, are these inversely correlated? And I think you know they're correlated, or I wouldn't be showing this. Perfectly correlated for the same reason. It's a trick. The point I'm trying to make is don't use visual correlation. It's just nonsense. There is a great website called Spurious Correlations. For instance, this one here shows the number of people who drowned by falling into a pool correlated with films Nicolas Cage appeared in. What great correlation. So when people show you these charts about the market and say they're correlated, they're not correlated, they just happen to overlay each other. Okay, wrapping this up, remember that big equation at the beginning that probably scared most people? That minus e to the I pi is called Euler's identity. It's probably one of the most, for a mathematician, it's probably one of the most beautiful identities in the world because it involves e, it involves imaginary numbers, it involves pi. E to the I pi is equal to 1. This next part, sine squared x plus cosine squared x, is the Pythagorean identity. It's equal to 1. And then from high school trigonometry, we know that if we divide 1 by the cosine of 60, which is 0.5, we get 2. This is what technical analysis does. 1 plus 1 equals 2. The top part is what modern finance wants you to think. So, 10 rules. Actually, I only have 9. I'm just about through. Turn the TV off. Stop surfing for the internet for advice. Turn off the noise is what I call it. Develop a simple process, one that you can explain. Mine is trend following. I've been a trend follower for a long time. Create a security selection process. You've got to have some way of knowing what to buy and when. Come up with a set of rules or a set of rules that you can follow. Write them down yourself. Make them up and make sure when you write them down you're not doing something crazy that you won't follow. And here's the most important part. You must have the discipline to follow this. Tell you a story about discipline. I've been on a diet my entire adult life. I was riding with my wife up in the mountains in North Georgia, and we stopped at an old filling station to get gas, and I had to go inside to pay for the gas, and I buy myself a candy bar. I knew she didn't want one. So I was coming back out to the car. I get in the car, and she's glaring at me, and she says, "You just don't have any discipline." And I said, "That's not true. You don't know how many of these I wanted." So if you don't have the discipline, and admit it to yourself and find a tactical money manager, Lance, anybody, any of these tactical people that will help you try to avoid bear markets and let them do it for you. And then don't confuse luck with skill. Listen and learn from the market. The market is always right. And then since everybody has 10 items in their list, they always put that at the bottom and said, read this list often. So thank you very much.